In this video, I'm going to explain the accounting elements. Why you should know accounting elements. Because accounting elements are the building blocks of accounting. These are the basic terms that you should know to understand complex accounting theories. So let's get into accounting elements. There are 5 types of elements: assets, equity, liabilities, income, and expenses. Let's take a close look at each element. First of all, let's see what assets are. These are resources controlled by the business. Or we can say assets are the resources that the business owns. There are 2 types of assets: current assets and non-current assets. Current assets are assets that are expected to be used or converted into cash within a year or 12 months. These are the short-term assets of a business. Some of the examples for current assets are stock, debtors, and cash. Do you know what stock is? Stock includes goods that the business sells to its customers. Then who are debtors? In simple terms, debtors are credit customers of a business. They owe to the business because the business has sold goods on credit to them. Debtors are also called trade receivables. Cash is simply the money in the business. Then what are non-current assets? Non-current assets are the assets that cannot be considered as current assets. These are the assets that are expected to be used for more than a year. Therefore, these assets are the long-term assets of a business, such as land and building, motor vehicles, machinery, furniture, and equipment. Now let's move into equity. Equity is the value of assets that belongs to the owner or owners of the business. We can find equity of a business by deducting the total liabilities from the total assets of the business. What are liabilities? These are the payables of a business, such as bank loans. Liabilities involve the amounts that the business owes. These are the current obligations of the business. There are 2 types of liabilities: current liabilities and non-current liabilities. Current liabilities are the liabilities that should be settled within a year. So these are short-term liabilities of a business. Creditors, accrued expenses, bank overdrafts are some of the current liabilities. Who are creditors? Creditors are the credit suppliers of the business. The business owes to the creditors because creditors have sold goods on credit to the business. An accrued expense is an expense which has been incurred but not paid yet. Examples of accrued expenses are electricity charges payable and salaries payable. I will explain the bank overdraft in a separate video. Non-current liabilities are the liabilities settled using more than a year. So these are long-term liabilities of a business. In other words, Non-current liabilities are liabilities that cannot be considered as current liabilities. An example of non-current liabilities is long-term bank loan. As the name suggests, income is the money that a business receives from its business activities. In accounting, we define income as an increase in equity except due to capital introductions. So income causes to increase equity. This means income leads to an increase in the value of assets belongs to the owner. Even capital introductions by the owner increase the equity. But remember, an income is an increase in equity except due to capital introductions. Examples for income are sales, interest received, rent received, commission received, etc. Sales are the main income of a trading business. Sales are income earned by a business from the sale of its goods and services. Finally, let's learn what expenses are. An expense is a reduction in equity except due to drawings. Even honest drawings lead to a decrease in equity. But the expense is a reduction in equity except due to drawings. Purchases, interest expense, rent expense, salaries, electricity charges are some of the examples for expenses. If you like this video, click the like button and share this video with your friends. Visit my website for more basic accounting tutorials. Thank you very much and see you in the next video.